We navigate a global landscape marked by geopolitical shifts, trade complexities, and rapid technological change, all of which challenge established norms. Our journey towards self-reliance will require channelizing our nation's savings into productive investments in modern infrastructure, advanced manufacturing, and energy transition, as well as strategic sectors like semiconductors, rare earth metals, and defense. Capital markets will be crucial to fund these ambitions. There is a changing paradigm of household investments. The foundation of any self-reliant economy is its own people's capital. We are witnessing a fundamental shift in how Indian households save and invest. SEBI's investor survey tells us that investors are motivated by long-term growth, building additional income, and goal-based financial strategies. The numbers speak for themselves. The count of unique investors in our capital market has surged from just over 38 million in FY 2019 to nearly 135 million now. The number of unique mutual fund investors has jumped from 10 million a decade ago to over 56 million now. Household savings channeled into mutual funds grew at a CAGR of 24% between 21 to 25, far outpacing the 9% growth in bank deposits. This isn't just financialization, we are witnessing democratization of wealth creation. This shift has created a powerful domestic counterbalance to volatile global flows. The rise of systematic investment plans now crossing 280 billion rupees monthly provides stable capital. Individuals directly and via mutual funds now hold a record 18.8% of NSE-listed firms. Our domestic strength now provides stability in a fragmented world. In the current financial year alone, equity and debt issuances have crossed 7 trillion rupees. A strong IPO pipeline indicates continued confidence in our markets. Instruments like REITs and InvITs have channeled significant capital into vital real estate and infrastructure assets. AIF commitments channeling risk capital into the unlisted space have grown at a CAGR of 30% over the last 5 years. Municipal bonds, though nascent, offer a direct route for cities to fund their own development. Nevertheless, India still remains a predominantly bank-led economy. Outstanding bank credit to industry and services stands at 91 trillion rupees, while outstanding corporate bonds stand at 54 trillion rupees. This highlights our primary challenge and our greatest opportunity. Deepening our equity, bond, and alternative investment markets is imperative to diversify and provide an alternate source of funding for our ambitions. In a fragmented world, our markets have to be investor and issuer friendly. Investors will commit capital when they believe the market to be fair, transparent, well-regulated, and capable of withstanding shocks. Our enterprises need more than just a resilient market. They need an efficient one. This is where easing norms of doing business become crucial. SEBI's role is a dual one, to ensure market integrity and to be an enabler of efficient capital formation. Let me touch upon some of the key reforms taken by SEBI. Let me see the bucket of ease of doing business. Just a few of them. Fundraising timelines. IPO listing timelines have been shortened to T+3, while rights issue timeline has been reduced to 23 days from average of 317 days taken earlier. Simplifying documentation. The placement document for qualified institutional placement has been streamlined by eliminating duplication of information which is already public. Large issuer listing. Changes have been recommended to allow scale-based guidelines for issuers to list with lower initial public float, public offer, consistent with market absorption capacity and minority shareholders' interest. Timeline to meet MPS has also been rationalized with due regard to liquidity. Anchor investor norms. The number of permissible anchor investors has been increased. Registered now included in the portion reserved for anchor investors. Let me come to the other developments as well. AIFs. We have reduced the minimum investment for large value funds from 700 million to 250 million to facilitate higher investor participation. Steps are being taken to promote the adoption of accredited investor status in our ecosystem. Corporate bond market. SEBI has focused on opening this market to retail investors. Face value of corporate bonds has been reduced to rupees 10,000. Online bond platform providers have been introduced to facilitate online transactions in bonds. RFQ platform has been introduced for secondary market, and liquidity window facility introduced to provide exit options to retail. Regulatory framework has also been issued for green bonds, social bonds, sustainability-linked bonds, etc. However, much more needs to be done to deepen this market. REITs and InvITs. Strategic investor category has been expanded to allow REITs and InvITs to attract capital from institutional investors. Classifying REITs as equity is also expected to further enhance liquidity of these instruments. Let me come to some of the measures on market integrity. Cyber resilience. A comprehensive cybersecurity and cyber resilience framework has been mandated for all regulated entities. Smaller intermediaries will be supported by NSE and BSE by setting up a Market Security Operations Center. Governance in MIIs. These are first line of defense. Measures have been taken to ensure they always prioritize public interest over commercial considerations. Stress testing MF schemes. These norms for small and mid-cap MF schemes directly enhance market resilience, requiring fund managers to ensure prudent liquidity management. Secure payment modes. UPI has transformed payments in the securities market, we all know. But the valid UPI handles and the SEBI check utility of SEBI, which we have introduced from 1st of October, has created a secure digital pathway for investors, ensuring that payments go only to registered intermediaries. Around 440 billion rupees of investor funds have entered the capital markets since October 1 through these validated UPI handles. Surveillance. Our revamped in-house systems are using AI and data analytics to generate alerts for manipulative trading patterns. We'll keep our regulatory framework for algorithmic and high-frequency trading updated to ensure fairness and transparency. Social media platforms. Digital platforms are being actively monitored for misleading content. We have escalated over 1 lakh pieces of such content to be taken down by the platforms. I have to also acknowledge some of the steps taken by RBI for the capital markets. The increase in the IPO financing limit for individuals from 1 million to 2.5 million will enable deeper retail participation in larger public issues. RBI has also enhanced the limit for lending by banks against units of REITs and InvITs while removing the ceiling of lending against listed debt securities. This will make these instruments more attractive as investment avenues. The government has also recently specified municipal debt securities as eligible for repo and reverse repo transactions. They can now be used by banks and institutions for short-term liquidity management. Their increased demand will empower our cities to fund their own development. So let's look at the way ahead. Looking ahead, how do we position India's capital market for the next decade of growth and self-reliance? First and foremost, education will be the key to ensuring responsible participation, especially as millions of new investors join the market. We are shifting from basic literacy to targeted education, focusing on market-specific risks and dealing with unregistered entities. The outcome of our nationwide survey is helping us understand investor behavior, and our outreach program will be tailored accordingly. For IPO-bound companies, the existing contents of the offer document summary will be further rationalized. This summary will also be made available separately to investor from the offer document to encourage informed feedback from them. The process for IPO-bound companies whose pre-IPO shares are pledged is being streamlined. The proposed framework will ensure that lock-in requirements are automatically enforced even if pledges invoked or released, thereby preventing listing delays. Consultation papers for these proposals will be out soon. For the corporate bond market, our way forward will be to make debt instruments more attractive for retail. We have floated a proposal to allow debt issuers to offer incentives to certain investor categories to encourage retail participation and other rationalization measures. A nationwide education campaign to make investors aware about this market will be rolled out shortly in consultation with all stakeholders. RBI and SEBI are consulting on introduction of bond derivatives too. Strengthening the commodity market is a priority for SEBI. We will work with RBI towards a regulatory framework to enable prudent institutional, where banks, insurance companies, and pension funds could also participate, prudential institutional access to the commodity markets. A proposal to allow FPIs to trade in non-cash settled, non-agricultural commodity derivative contracts is currently also under examination. In closing, financing India's future in this complex global environment is a shared responsibility. SEBI is committed to being a responsive, forward-looking regulator. We value the insights of all stakeholders present here today, policymakers, fellow regulators, industry leaders. Your partnership is crucial as we navigate the path towards a $5 trillion economy and beyond. Let's work together to build a capital market ecosystem that is robust, inclusive, and truly fuels India's quest for self-reliance. Thank you. Jai Hind.
Thank you, sir. Thank you for those encouraging words. Now may I please invite on stage Sri Vinay Tonse, Managing Director, RBNO, State Bank of India, to moderate this session of Q&A with the SEBI Chair. Ladies and gentlemen, please give him a huge round of applause.
Good evening, everyone, and Mr. Pandey, thank you, sir, for making it here. Despite I know that you had a very, very busy schedule today. Thank you very much for making it here. As we were entering this hall, you were asking me how was your experience, getting out of the bank into the mutual fund, SBI mutual fund, and again coming back. And whatever you were just alluding to in your comments, one of the things that strikes me is that when I was there, we were talking about mutual fund sahi hai. और इतना strongly वो हो रहा था कि when I came back to the bank, I was finding that all my deposits were going away into the mutual funds. And then now we have to start that कि banking भी सही है, mutual fund तो सही है तो definitely. So that was the period when we saw a lot of this shift happening towards what you were just mentioning. And in that context, sir, I just start with I will have some questions which I have for you on my own, and then we open up because there's a lot of demand coming for asking questions on many requests. So before opening up one particular point, sir, democratization of wealth creation is what you just mentioned. And if you go back a few years, around maybe 2014 or 13, when originally the definition of financial inclusion had come, there were actually three pillars. One was Jan Dhan, basic access to formal systems of banking. Second was Jan Bima. And the third was Jan Nivesh. The first one, PMJDY, through the PMJDY, we are aware of what sort of progress we have made. And Jan Bima also, insurance for all by 2047, I think we are strongly in that direction. Where would you place Jan Nivesh, sir? Like taking capital markets, access to capital markets is what the original definition mentioned. How far are we, or are we on that direction? You are talking about outreach, you are talking about literacy, education. Where are we on that?
It's a very good question. Also the fact that, Jan Nivesh has to be also understood in terms of more holistically, in terms of balanced portfolios. And I think we are, many a time, we are only looking at segments like the banks are looking at, there's a certain amount of money the people should be having a fixed income portfolios. The fixed income portfolios could be a bank as well as the bonds. And there could also be, insurance and pensions. And there could be then some certain allocation for commodities maybe, and as well as the securities and the mutual funds. Now, I think this is the more holistic education that eventually we should be able to do rather than a very segmented way which we are there, like you are saying, mutual fund sahi hai, bank sahi hai, some insurance bhi sahi hai, pension bhi sahi hai, actually sab kuch sahi hai. So basically what we have to really bring in a concept of, the overall asset allocations for every individual's suitable to its own, life, and also suitable to a certain point of time in which they are. I think we are, to some extent, a distance away from that holistic education, because each one is reaching their segments. Although we have a National Center for Financial Education, where all the regulators have come forward and created an organization. And under that organization's umbrella, a number of, awareness programs and outreach programs are undertaken. But we need to do far more given the size and scale of our country. So one important thing in relation to the securities market, we had actually, along with our ecosystem, securities ecosystem, we commissioned a study, a very large study, a survey, of which, we released it a couple of months back, and it's out in the domain now, public domain. And that survey brings in a lot of points, at least on how the people are looking at investments, particularly in relation to the securities market. And we found that, there's only 9.5% of households are currently invested in securities market. 63% of them are aware of the securities market, that some kind of understanding of stocks or mutual funds. 22% of the remaining out of those 9.5, if you exclude, and the rest remaining, and 22% of them, which is actually a very large number, they were intending to come to the securities market within the next 1 year. That means next 12 months, which is like a very, very huge responsibility. And 36% of the households has had some fair knowledge of the financial markets, of the securities market. So in terms of outreach, the people who were surveyed, they were really giving us a lot of clues on how would they like to be approached upon. Now, there is a lot of generational change. Elder generation will think differently. Maybe they would like programs to be more like one-to-one, personalized. But younger generation like short videos. And so we got those kind of granular details as well. In terms of language, we had only 5% was saying that they would like to be educated in English, and 47% were wanting to be educated in Hindi. Then we have 7% in Tamil, and then Bengali, and Telugu, and Marathi, and Asmi, and Odia, and Bengali, Nepali. Now, we have to now go back into the languages, getting to speak to the people in their language, and also then bringing down the correct messages. So not nearly only from the point of view of our own promotion of a product, but actually promotion of this concept of balanced portfolio, where you are mixing, it's not everything should be in equities, not everything should be in fixed income, but a mix, and having balance and having a good idea of pensions and insurance needs as well. So we should actually, regulators should put kind of this campaign on a much larger scale. But yes, in terms of various other measures that we need to take on respect of securities market, we have right now SEBI versus scam. Last 2 months, 3 months, you had this campaign where every part of the ecosystem, SEBI's ecosystem, was talking about, how to prevent scams and some of those scams which are there. And within that, actually, a very important initiative like validated UPI handles and SEBI check, which is 30-second, you can check whether this account is fraudulent or not, in terms of valid or not, in terms of securities market. So therefore, there's a very important piece of work which SEBI and its ecosystem and the banks and the NPCI have done together in order to provide a systemic support or a shield against the cyber frauds.
Thank you, sir. Sir, all of us, any player in the ecosystem in India, the financial ecosystem, keenly watches what the SEBI does and what the SEBI says. So all of us are also very appreciative of the fact that so many initiatives have been taken towards ease of doing business, and how do we tap the fundamental shift which you alluded to in the behavior of savings. I'll qualify that, behavior of investing from the thrift part. I think it's very, very laudable initiative, many initiatives. Which among these initiatives do you think, personally, is the most critical, and what do we get to see in the next, say, 6 months or a year, which you would feel is extremely critical for this?
So I think on fundamentals, what are the SEBI's roles? The Parliament has given us 3 roles. 1, investor protection. 2, market development. 3, market regulation. So how do we really balance? And not each one of them is not really mutually exclusive. In many cases, these are intertwined. Maybe a good market development also involves essentially investor protection. That we have investors on one hand and issuers on one. We are only facilitator of capital formation. And therefore, we need to work on investor protection at certain stage. And investor protection also we have to see one size doesn't fit all, because there are different risk profiles for different types of investors. And there are different types of products which have got different risk profiles. So therefore, we cannot have one size fits all approach in our regulations on investor protection for different risky products and different types of people who can take risk. That's one point where we need to have a balancing of regulations. The second is market development. If we do not have REITs and InvITs, then obviously a great deal of capital formation which could come in terms of infrastructure and real estate won't take place. Today, it may not be necessary for you to actually buy a real estate if you get a fraction of it, which is actually a REIT is, and then get that relatively stable flows of rental incomes to this thing. Same thing applies to InvITs, where a lot of capital formation can take place through rolling of investment, through asset monetization, the people building assets and then forming InvITs and use those collections to build further infrastructure. It's very important for things like NHAI or other agencies which have to build large-scale infrastructure to raise money. But market development would also include several other products. In derivatives, for example, the different types of needs of hedging, and both on commodity side, on forex side, on interest side, and RBI and SEBI to that extent will have a lot of role to play going forward in continuing to provide different opportunities for hedging. Now, market development also involved, developing some other different products. For example, AIF industry. Now, AIF deals with a certain different segments of risk and investment. Now, the third pillar, which is the pillar of market integrity, that actually combines the market. That is actually the fulcrum under which the whole system works. So we have now the rights of investors. We have also the duties of investors. Similarly, we have rights of issuers and we have duties of issuers. And then we could have rights of the intermediaries who support it to bring the savers and investors together, and also the duties of those intermediaries. And therefore, the entire ecosystem, an efficient ecosystem, and whenever we keep in mind regulation, I think regulation should be the right regulation, the optimum regulation that would be actually fit for purpose, contextual. It should be also, cost effective. We should see these elements and maybe we can build up our regulation making capacity accordingly, and also look at our previous regulation and update them or right size them or rationalize them accordingly.
Thank you, sir. So just one more question from my side before I open it to the participants today. Sir, we have seen rapid transformation of the Indian capital markets of late, and technology. Of late, you have also spoken about the disruption or the apprehensions that can come out of such technological disruptions. Do you have anything specific in what is it that gives us the anxiety?
I think there is nothing to feel anxious about it, except that we must move with technology in tandem. Technology is a great enabler. Technology can also pose a threat in terms of if risks are not managed properly. So therefore, we have to just go on with this. Like, for example, the algo and algorithmic trading and HFT trading. This is actually a fact of life. And it has been enabled in a certain way with certain guardrails. And accordingly, I think we have to keep on saying that with every technology also comes, or every innovation also comes accountability. So therefore, it has to remain together, and the regulators need to work with industry and the technology players to always keep our technology updated. However, I see that, in some ways, we have some important things to note from the quantum computing, because that will be a fair amount of, I think, could be disruptive, very disruptive, if we don't take the necessary measures well in time. And I believe that in India and in SEBI particularly, we would be emphasizing a lot on the necessary preparatory steps which need to be taken to be in readiness to do the post-quantum cryptography in a manner where our systems function smoothly.
Thank you, sir. I now
good evening, sir. You mentioned about commodities. It's something which I'm very passionate about personally as well. Could you, sir, elaborate on what really we are looking forward to? Because it is one market where there is a lot of hope and where there is a lot of need, but that market hasn't really done as well in India as it should in terms of offering the ability to hedge for all the participants. So, sir, what is the plan SEBI has for deepening and expanding this market?
Which market, please?
Commodities, sir.
No, I think commodities market in India are definitely not as it should be, given the India's size. We know that in many jurisdictions, commodities markets are even bigger than the equity markets. And commodity markets we have, of course, one peculiarity in terms of the division of powers between the states and the center. The cash markets, the spot markets in commodities, agriculture, and many others are with the states. And we can only do the derivatives. In many cases, we have the farmers' needs, which are not exactly derivative oriented. They would like to, when they bring the goods, when they bring their produce, they would like to be paid for immediately, which is actually a spot. And but then we will say that, okay, we'll pay you in future, and you build up a future market. Future is something which we can do. And then we have also issues regarding, if you have to take a delivery, then you have different places. There could be godowns or warehouses in different jurisdictions, and then we have to settle the GST issues as well. So there are some critical issues which need to be settled. So we've created a working group for agriculture commodity derivatives, which are now looking at all these issues. And once this report is there, we should be able to carry it forward, take it up some issues with the government to resolve, and also some of the issues which SEBI can resolve, and some of the issues which the industry and their industry participants can resolve. And then you have non-agricultural side, which is also fairly big, and you can have several kinds of contracts which can come in. If you see that, even the base metals, we aren't really doing in every base metal as well. We have lots and lots of potential on industrial products which have not still in our horizon here, and which means that a lot of education is required, because industry has to come together along with the exchanges to develop those products. As such, I think SEBI would be proactively working with the commodity market participants to expand the number of products and all that. In electricity derivatives, recently we have gone into, exchanges are doing it. There are other opportunities in electricity derivatives. Could be, for example, contract for difference, CFD contracts, which could actually propel the markets to do that. There could be virtual power agreements. So electricity is one area where, again, a big potential is there for the market-based price discovery, and therefore indicating the capital formation and taking capital formation accordingly.
As an extension to terms of commodity derivatives, it is also important to work with RBI. Today, banks are not permitted to do anything to do with commodity derivatives. While we have a lot of demand from our customers, very fairly large corporates dealing with both the non-agricultural commodities which you mentioned, particularly on the metal side, coke, and many things what they import. They're looking for some derivative products. Today, banks write the largest forex derivatives, whereas we are virtually absent on the commodities side because of the regulatory restrictions. Probably when you are working on exchange-based deepening of the derivative markets, I think it is important to work on the bank side also.
No, it's very well, because I think if you would have noticed, I specifically mentioned in my address that we will be taking up with RBI to encourage banks to get into the commodity derivatives with whatever guardrails, etc. But prudently, but yes, it's important that they can also get in there. And also that we have, when we look at the commodity the foreign exchange exposures, we are more, like from the SEBI point of view, we say that you should state, the listed entities should state the exposures in their balance sheets and what are the foreign exchange exposures and commodity exposures. We do have certain penalties if you have exposures which are not hedged. And so therefore a lot of people on the foreign exchange side do go and hedging because there is a higher capital requirements. But the similar thing is not true for commodity exposures. Commodities also important because in India, sometimes we are a very large user of commodities, but we are practically only a price taker. We don't determine the price. Nothing is there. We're still talking of London or some other foreign markets for commodity pricing. So it's important because, the size of the market, the depth of the market has to come before we can do that. It's an important thing.
Good evening, sir. Your speech is very impressive and interesting. Rather in morning gatekeepers meeting and as well as now bankers event. Sir, I have two questions. One, why SME is becoming...
I hope I don't end up in only making speeches. We also do something.
No, but it's very interesting. I have two questions. One, why SMEs are becoming NPA? Because corporates are not paying on time. They are searching many avenues for a delay for the payment, number one. And second thing, why more SMEs are not listing on the SME stock exchange? Maybe because of the fear or maybe because of not given the proper attention. So is there any plan from the SEBI? Because I advocated to start this SME stock exchange in 2008 onwards during the SEBI, Mr. C.B. Bhave. So currently around 1,200 companies are listed and around 180 companies gone to main board. So is there any plan by the SEBI where encouraging more, because we have 7 crore MSMEs in India. In that at least 1 lakh SMEs can listed on the SME stock exchange to enter in capital market for alternative finance to reduce the burden from the banks. Do you have any plans particularly to encourage more SMEs using the particularly fair business practices, good governance, and of course to enhance the manufacturing activities in India to march toward Viksit Bharat? Thank you.
I think the SEBI has enabled for a long time the SME IPOs, and in fact the exchanges were enabled to do that IPOs themselves, and these need not actually come to SEBI. They don't come to the SME board IPOs. Their offer documents, etc., do not come to SEBI. It was basically intended that SEBI probably cannot process all that stuff, so that number, and they can do it better with the exchanges. But there have also been, while several successful SME IPOs have been done and many companies are doing, there have been also some egregious behavior through the SME IPOs, and not necessarily, I would say that only at the instance of SMEs themselves, but also some of the market intermediaries who are supporting the IPO, namely the merchant bankers, where, number one, what's the cost of issuance? It's very important. If you're going for 20 crore, 30 crore, raising of money, what is the kind of charges you are paying for the intermediation? If it is too high, it is, I think, better that SME does not approach it. So what is the real value of market? It's very important for SMEs to organize, and certain size has to be there. I think very tiny size coming to the capital market will not be actually cost efficient. The second, there has been also egregious behavior we've noticed in terms of people actually doing a scheme, many of the people doing a scheme to siphon off the investors' money. Now that will actually put a very bad name to SMEs, and it will also spoil the name of several other SMEs who are very hardworking, who are doing all that stuff. But just because, a few IPOs have gone wrong and the people are having a lot of apprehensions about the SME. So it is important that market integrity is always maintained. While there could be a certain amount of business risk inherent in any business, but once you raise a money for an IPO, you obviously cannot divert the money if it is not for intended purpose. And you can't really spend from general corporate purpose huge amount of money. And certainly you cannot use the money and roll it through different accounts and siphon it off. There have been cases around that. I'm not saying, I'm not stereotyping, I'm not generalizing. I'm only saying that we have to tread with caution in terms of bringing credibility to SME IPO market, and some measures, for example, SEBI had to take in order to dissuade, because earlier profit was not also there. Now we said the certain amount of profitability, certain number of years in the last 5 years, you should be profitable. You should not be able to do so much of money for only general corporate purposes and so on. So this was also brought in. So I would say that we should take a balanced line. Definitely there would be a lot of scope for good SME IPO. But I would like to sit with SME associations and others and exchanges and banks and to really work out what is a kind of model which we can have. What could be a cutoff point at which we would say that it will be viable for the companies to come and list. And also, what could be the safeguards in which we will continuously maintain a certain high level of integrity into this market.
Thank you very much.
Good evening, sir. Taking a clue from what you have just mentioned, sir. So SME IPOs are very attractive when it comes to the investment point. And there are several investors who are first-time investor also through IPO. So, sir, whether SEBI, in some of the cases, it has been observed that within few months or within few days, the prices of those shares gone down like anything. And investors' interests are not protected, those who are first-timer or those who are new. So whether SEBI is thinking of some kind of initiatives protecting the interest of those investors, maybe some period, 3 months, 6 months, because it is all about the valuation. So there has to be something wrong with the valuation of the company. That's why the share prices crash like anything. So whether SEBI is thinking on those lines, protecting the investors' interest or not.
I think this valuation, if you say we are actually into a free market, so it's very, very difficult when we say that, the pricing is free, people are able to value each other. SEBI has typically, you have as many disclosures, and therefore we would also now, if we find that there is only we will have the highlights also being offered. That's what we are working, and we'll have I referred to that. We'll have a consultation paper in addition, small, where the investors can easily look at it. But भेड़ चाल नहीं चल सकती, क्योंकि आपको एज एन आपको कुछ पढ़ना पड़ेगा, कुछ देखना पड़ेगा. और दूसरा, हमको हमारे जो अनसॉलिसिटेड टिप्स आती हैं, जो कि उसको पंप कर देते हैं और लोग उसके बहाव में बह जाते हैं, तो दिस इज वेयर हमने 1 लाख ऐसे कंटेंट को निकाला है जिसमें कि लोग स्टॉक टिप्स दे रहे हैं, किसी के बारे में बात कर रहे हैं, और उसमें उनका क्या इंटरेस्ट हो सकता है। तो सेबी ने ऐसे केसेस भी पकड़े हैं जिसमें ऑर्गेनाइज पंप एंड डंप है कि आप 10 लोगों को ले आइए और वो आपके बारे में अच्छी बातें करें, आप स्टॉक को बढ़ा दीजिए, उसके बाद प्रमोटर्स ही उसको स्टॉक में अपने आप को सेल कर देंगे और रिटेल के पास जो दूसरे इन्वेस्टर्स हैं उनके पास आ जाएगा और फिर स्टॉक प्राइस गिर जाएगा। तो इस तरह की स्कीम्स भी सेबी ने पकड़ी हैं और बहुत सारे ऑर्डर्स हमारे पास हुए हैं। सो अब इतनी बड़ी मार्केट है, उसमें एग्रीजियस बिहेवियर एंड ऑल दैट, ओनली थिंग इज वी हैव टू सी हाउ वी आर एबल टू, एंड देयरफॉर इट रिक्वायर्स अ लॉट ऑफ इकोसिस्टम अप्रोच कि जो मर्चेंट बैंकर्स हैं वो कितनी ड्यू डिलिजेंस कर रहे हैं ऑन प्रमोटर्स क्रेडिबिलिटी, क्या वो ये चीज़ें देख रहे हैं कि जो इंटेंडेड पर्पस के लिए पैसा जा रहा है कि नहीं। इवन वी हैव नाउ आस्क एक्सचेंजेस, दे आर ऑल्सो डूइंग सम फिजिकल इंस्पेक्शंस टू डू इट, कि आप देखिए कि जाके वहाँ पे जो क्लेम किया गया है वहाँ प्लांट भी लगा है कि नहीं लगा है। सो I think we have to continuously monitor the situation, and constantly our efforts should be to promote good business and catch hold of the scoundrels and punish them.
Hello sir. So India being mostly like a saving based economy, and in the last few years we can see like the under income tax, the government is offering like income taxability on the income and disallowing various deductions. One of such deductions was under ATC, wherein we used to get benefits for investing in the mutual funds. And basically, as per the new taxation, the government has actually led to having a higher fund flow in the hands of the youngsters who are earning a good chunk of money. So how are we planning to get these funds into the system wherein the youngsters will be like given some sort of benefit under the taxation to invest in the mutual funds?
देखिए, जो नई टैक्स रिजीम है उसमें तो वैसे ही 12 लाख तक आपको कुछ देना नहीं है टैक्स, तो वैसे ही सरकार ने सबको टैक्स कर दिया। तो जो नई टैक्स रिजीम के हिसाब से आप अपना डिसाइड करिए, हर चीज आप टैक्स से क्यों जोड़ते हैं। यू अल्टीमेटली यू हैव टू कैलकुलेट व्हाट रिटर्न्स यू आर गेटिंग। सो दिस होल अप्रोच कि देयर विल बी अ लॉलीपॉप एंड देन ओनली आई विल डू दैट, उससे तो हम 5 ट्रिलियन 10 ट्रिलियन इकोनॉमी नहीं बन सकते, क्योंकि इधर की पैसा सरकार का पैसा ले दिया आपको दे दिया, उससे तो कोई बात नहीं बनती। एक्चुअली इकोनॉमी में पैसा जनरेट होना चाहिए, आपको रिटर्न मिला। सरकार को तो अपना पैसा चाहिए in order to do the infrastructure and to do all that stuff that we have to do. So therefore, I don't think that approach is trying to really spoon feed you in order to say that you will get this concession, so you buy an insurance, you get this concession, so you do that. This kind of an approach has already been done away with. The question is, the youngsters today, they are not really looking for this. In general, they would be looking for their own, they are much smarter. They look at their investments. Yadi log, after this regime also, if money is not staying with the banks too much in the saving banks accounts and quickly it is going into investments, तो लोग कुछ सोच समझ के इन्वेस्टमेंट्स कर रहे हैं, उसमें बिना टैक्स के भी तो इन्वेस्टमेंट्स कर रहे हैं।
Hi, we will have one last question from the audience, please.
Hi, sir. Am I audible?
Yes, yes.
Okay. Firstly, thank you, sir. In the sense, SEBI has done a commendable job, in getting out reforms and changes for developing the REIT market in India. The way you actually mentioned from a household perspective, it's important that you have a diversified portfolio for savings and investments. I think it's also imperative that a product like a REIT, which is still nascent today also has a diversified source of borrowings. As you know, as most of us in the room are aware, REITs are actually pushed into a corner that they can borrow only from the bond market today. They are not permitted to borrow from banks. If you look, if you step back and look REIT as a product, it's far more safer, it's far more stable than any other listed real estate company. And if you actually permit banks to lend to REITs, it will be a win-win for both the parties. And in summary, it's the end investor who's actually going to gain, because having a large issuer base like REIT being dependent only on the bond market is also not a good idea. So my only request would be to, whenever you're actually raising this with the other regulators, this is one topic which you should also consider. Thank you.
I think our governor is very wise, and he is taking all the steps necessary to relook at the constraints which are binding the banks.
Thank you, audience, for all these questions. Sir, but before we close this, I have one question. Last week we had a consultative paper on the corporate debt market, securities, and we have been hearing for a very long time, almost now 15 to 18 years, if I recall, about how do we deepen the corporate bond market. And many times, we seem to be going somewhere, then again a few steps back. But this consultative paper I thought was quite good because it is looking at both sides. One is the retail side, one is the demand side, and one is the supply side. So how are we incentivizing the retail to get into this, which would be a good move considering the shifting of, or rather the financialization happening. And then on the other hand, also reducing the compliances. So do we also have any thoughts on getting the lower rated issuers into this? Because that's been a long-standing demand. Any thoughts on that, sir?
I think you guys can actually advise us better, and I'll definitely put you in one of the committees to see how the corporate bond market can be really kicked up. So we know that there are some issues. One is that, compliance burden, etc. We will look at it, in some respects, for the bond issuers and equity issuers, we have actually equated, including the intermediaries, those who deal with the bonds and those who deal with the equities. We have, to some extent, in SEBI, we have just borrowed it from equity and put it on the bond. I think bond is a different thing, and we can have a much better, much less complying thing for the people who are dealing with that. But actually, bond market in India is still, a lot of OTC market. It is like telephone market, because it's a big institution, and some of you are there in this room. Some of them are connected through VCs. Most of them you are doing in OTC market. Now, OTC market, what we have done is to bring you to the EBP and at least say, okay, you bring and do some price discovery there. But volumes are not coming up. So that is one. Secondly, since there is the SEBI is saying that you please take the ratings and please come to all kinds of bonds. So SEBI is not, as a regulator, we aren't saying that you only go AAA rated or AA rated. Why aren't those bonds coming? Why aren't those bonds, being subscribed to, being demanded? One of the reasons is that, the people who are there, in at least in terms of equity, you have, 130 million investors, and, equity culture is much, much more advanced. But knowledge about bonds is still very less among general public. And also, we haven't really done much work on educating them about it, on bonds. Because typically, it has remained a OTC market between institutional market, between big players. And unless and until secondary trading comes in, and one of the reasons we said that bond derivatives can do is to encourage it. But there would be a lot of secondary trading which needs to take place, where the people can say that we are not holding to anytime we want to get in, and any type of thing, the whole yield curve. So we have to really keep working on this to improve the secondary trading in the market so that people have liquidity and the people know that if I'm holding a bond, I don't have to struggle to find out a buyer. To some extent, this OBP, which is again an initiative which SEBI took after the market was already happening. Since the market was happening, people were really doing it, and therefore we brought in a regulation and to give it a more credibility and more to orderly development, where through OBP, at least the people, the 10,000 rupees money, they can go and find a bond in the OBP platform. And then for having the NDS OT market to get the individuals to buy a GSEC, our effort has been, because instead of every individual going separately to the, RBI direct, it can also move through the brokers to that, the market, so that, you are able to maintain a common portfolio. And I think with the RBI's efforts, at least that part, what we call phase one, we wanted to be on exchanges, but right now it could be, the GSEC being traded through the brokers to the platform, RBI's direct platform. So we have to create more and more depth in the market in terms of both the kind of categories of bonds which are trading and also the number of players and different kinds of players who are going and placing their investment on the bond market.
Thank you very much, sir. And again, my thanks on behalf of the chairman and all of us at State Bank of India for your very insightful keynote address, as well as your very patient and elaborate responses. So, ladies and gentlemen, that was Mr. Tuhin Kanta Pandey, who had to keep aside a few of his other meetings to be here with us in person. Thank you very much, sir. Gratitude.
Say, Mr. Pandey, thank you so much for that enlightening session. Now, may I please request Chairman Sir to come on the stage and present SEBI Chair with a green certificate. The applause should not stop. Ladies and gentlemen, please put your hands together for the SEBI Chairman. Ladies and gentlemen, please take your seat because the next session is about to start. May I please request everyone in the front, please take your seats because we are about to begin with the next session. Everyone gathered around the hall, around the gates, and in the front of sofas, please sit down, please have a seat. We are about to begin with a very important session. Requesting our media friends also to please sit down. Don't stand in front of the gate. In the front also, may I please request, gentlemen, please take a seat so that we can begin with the next session. Now, our next address focuses on the evolving future of the financial services in channeling resources, financial deepening and digital inclusion, enhanced credit delivery, protection of the customer, and pioneering role of the banking sector in an expanding economy. For this special address, I would now like you to put your hands together for Shri M. Nagaraju, Secretary, Department of Financial Services, who's joining us virtually from New Delhi. Please, a huge round of applause, ladies and gentlemen, for DFS Secretary M. Nagaraju. Over to you, sir.
Thank you. Good evening, ladies and gentlemen. Mr. Sethi, Chairman SBI, and the MDs of SBI, Mr. Ashwini, Mr. Ram, and Thonse, and all the board members of the Mr. Ram, and all the board members of SBI, and all distinguished participants. I think it is an understatement to say that I'm delighted. I would actually very happy to be with all of you today evening, but for my unavoidable engagements here, one with the Parliamentary Committee, the other with the Chief Justice for a selection meeting, I could not join all of you. But I hope since afternoon you are all of you having good time with the FM being there, I think now SEBI chairperson has addressed. Let me, I think, begin talking about the vision of Viksit Bharat 2047, what it is like, how actually financial sector could contribute to the goals of Viksit Bharat 2047. The Honorable Prime Minister has mentioned repeatedly in his public communications. You know, to reach the broader goals of Viksit Bharat, to reach $30 trillion and between 20,000 to 22,000 per capita USD in 47. You know, we have actually some statistics we have. We actually calculated how much is the outstanding credit to be delivered for the non-financial sector to meet the target. Now that is that comes to almost about 40 trillion. So about 40 trillion of outstanding non-financial credit would be required in 2047 to reach the Viksit Bharat goal. And what does that key mean is that the outstanding credit, actually credit has to grow an average of 13.3% annually to reach in 2040. And then the GDP, and the GDP is the 30 trillion. Also, it has to have a CAGR of almost 9.3. Now, that is a challenge for the entire country as such, not just for financial sector, but entire. Now, the other thing, which is now, all right, we are assuming that we reach 30, we reach credit to GDP ratio 39 trillion. Then to provide that amount, how much actually banks will be requiring capital? The banks cannot actually do on their own. See, the incremental growth, that may not be actually adequate to meet the goals or aspirations of the country or the government or many of us. We need to assume 1.5 of the CRAR. It is about a little more than $4,000 billion. That is the amount of money required to support 30 trillion the GDP and almost 40 trillion of outstanding credit in the country. Now, if you assume little more, little higher than the regulatory requirement, if you assume 14%, we will be requiring more than 5,000 billion USD to support that vision. Now, I think all of you know that the deposits and borrowings accordingly have to grow. And these are now, what are the basic things which we need to, how do we achieve this vision? When we look at it, of course, we have been talking about it. By the time 2047, some of our banks will be the large banks, very big banks, and